All right. Happy Friday, everyone. We are live on all the appropriate channels, or at least the ones that will allow us to speak. Let's get started. Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host. And today I'm joined with my good friend, Doug Hagren. Hey, Doug.
How are you doing? I'm sure we're alive on some inappropriate channels too, Kirk. Let's just to be very clear.
I am not actively marketing our show in inappropriate channels, Doug. What they do with the show is up to them. With video the way it is today, with AI, they're probably going to have me there with, I guess Trump last night was putting filters on some of the politicians. From what I heard, I didn't look at any of that stuff, but it's like, yeah, people are going to put like horse filters on our head. I'm sure, go right ahead. I will just tell you, I am not a cat. That's all I'm going to tell you.
You had to clarify. You had to clarify it was appropriate channel. So I assume that meant there was a disclaimer. There might be some inappropriate, but maybe I misunderstood.
Definitely not. No, you're not on any inappropriate channels voluntarily. If people put it on there, I have no knowledge of that, nor any interest, quite frankly, in knowing where that's going. But I doubt anyone would have any interest in the inappropriate stuff. But as we dive right in, obviously it's a brand new day, and it's interesting. And I want to kind of talk about a few things today. There's some really interesting stuff. And obviously some interesting things happen in the markets this week, but I want to kind of dive right in because really I got this email. I got a message from somebody on LinkedIn earlier this week. And the message was basically, I'm going to see if I can read it here, but I can't find it. By the way, I really don't like LinkedIn's platforms for communication. It's really horrendous. Stuff is just all over the place, but let's see if I can find it. Well, anyway, while I'm looking for this, the essence of the message was this. He said, well, you tend to be too bearish. Why are you always so bearish on the show? And here it is. Let's see. He likes the show. I'm not going to give us the kudos he gave us, but like the show. But you tend to be a little bit bearish and on the show. And it's a long message. So thank you, by the way, Stephen, for the message. Love the feedback. Always looking for feedback. Listeners, if you want to give us feedback, we love it. We'll read it here in the show, whether it's good or bad. But basically, he said, you tend to be very bearish in the show. And what I want to explain to the listeners who have this feeling, the market is driven by fear and greed, right? And the market goes up and down, and fear and greed drive that for the large part. And we're human beings, but we're also animals. We have an animal side of our brain, right? The lizard brain, as some people call it, which is reactive to fear and greed. And the problem is that investing is basically like taking that emotion, putting it on steroids, right? Because you got money at risk, right? If it does well, great, I'm rich. And if it does poorly, oh, I'm poor. Like I just lost all my money. That's normal, right? And so there are a lot of shows out there that are permabulls. They're like, oh, everything's going to the moon, crypto, gold, whatever. Like go all stocks, all in, big tech. Everyone's got a thing, right? They've got their shtick, if you will. And you have to understand everybody's shtick, if you will. Some people are gold bugs. Always gold all the time. Everything is gold. Gold's going to the moon. It's going to keep going higher. Gold's in the toilet. It's going to start going higher. Bitcoin. What do they call Bitcoin bugs, Doug? They call them
hodlers.
Hodlers, yeah. Hodlers, right?
Hodlers, yeah.
Yeah, hodlers. So people like that that basically hold on for dear life, and we're just going to hold on forever. That's great, and there's nothing wrong with that. The problem is that markets don't go in one direction forever. So gold bugs, hey, I love gold, but I'm not a gold bug, right? I'm more realistic. I look at it and say, yes, this is an important part of the portfolio for very specific reasons. We typically have a gold position in our portfolio almost all the time. Now, does it mean it's always going to go up? No. But do we try to add when it is? Absolutely. And we'll talk about gold this week because it actually just broke out to all-time highs, which is woo! Gold bugs, high five. So, but if you look at all of these different aspects of the market, people tend to have an opinion. Now, we try not to have too much of an opinion on the show. Now, obviously, that's really hard. We're human beings. I do have an opinion. Doug's got an opinion. We actually have very strong opinions. And those who listen to the show a lot know that we have very strong opinions. However, what I try to do in the show is to educate people on how to think, not what to think, right? A lot of these shows are like, here's my thoughts. You should follow what I say. I actually try not to do that. And it's really hard. And so a lot of me comes out in my opinions, but I try to hold back because the more I tell you, the more you're going to try to follow what I say and think that this is the way to do it. The best way to think about investing is actually not to listen to other people's opinions. And the best way to get better at investing is to learn how to think about investing. And it's actually, it applies to life. Life is a series of mental models that we create for ourselves from birth, right? If I fall down, I get hurt. I'm going to try not to fall down, right? You learn that when you're 1 years old or whatever. You learn that you should have respect for your elders. Hopefully, at least when I grew up, that's the case. But you learn all these mental models based on experience, right? You do something stupid and you get punished for it. Okay, I'm going to stop doing that stupid thing, right? That's the point of punishment. So we learn all these mental models. Some are correct and some are not, right? You might have a very bad parent and they imprint a very bad mental model on you. Something that let's say you talk back and you get smacked. Okay, you learn the lesson not to talk back, but do you really want the mental model of getting smacked is a good idea for your kids, right? So there are a lot of mental models that we learn. Some are good and some are bad. But in investing, most people's mental models are actually just things they formulate based on other things. It's we as human beings are wired to watch out for the saber-toothed tiger behind the bush, right? If you're walking alone at night and it's dark out and you hear a rustle, you're like, "Ooh, what was that?" Right? That's our lizard brain operating. And obviously, we know there's no saber-toothed tiger, or at least we hope not, in the middle of the city. But it could be something else. It could be danger. And when you get to investing, we have similar models with investing. Like, oh, the market's going down. I should get out. Maybe. What was your plan? Was your plan to get out if it goes down, or is your plan to buy more? And at what point do you buy more? At what point do you get out? So the reason that we talk about having proper mental models as well as rules is that if you buy into a position, you have to have your exits laid out, right? It's like going into battle. You have to have your retreat. You have to have all your options laid out. If this happens, I do this. If this happens, I do that. You have to think through it in advance so you know. Because if you're just buying Bitcoin and holding on for dear life, and then it goes down 70%, and you're just like, oh crap, I can't take it anymore. I'm going to get out. Well, that's dumb, right? Because it pretty much consistently will go down like around 70% in a bear market for crypto. That's normal, right? That's the time you want to buy, not sell. So you have to fight with your lizard brain all the time. And so when we think about investing, and this guy's point, getting back to Stephen's point, was basically I tend to be bearish. Well, the reason I tend to be bearish on the show is because I'm trying to impart wisdom of risk management. I find that risk management is one of the most important things you can do as an investor. And most people don't even consider risk. They just say, oh, this is going up. I mean, I see this all the time with new prospects that come in or like, how's my portfolio? And you're like, oh, how'd you do last year? Like, oh, I was up like 25%. Like, I doubt that because the market was only up 10 and nothing was up 25. So it's unlikely. In my head, I'm thinking this is unlikely. And I see it. It's like, oh, actually, it was like 8. But people don't always have a good grasp on it. And people tend to be bullish. They tend to look at their 401k options and they say, huh, all right, this one went up 10, this went up 15. I'm going to choose the 15%. And they know nothing about the investment. This is normal, by the way. So if you're doing this, don't feel offended because everyone does this. And it's not the best way to do it, which is why we're talking about it. I focus on risk management. Risk management tends to be bearish in nature. It doesn't mean I'm bearish in nature. It just means that risk management tends to be bearish in nature because what you're doing is you're looking for the exit right when you're walking in the door, right? It's like an assassin walking in the room. They know exactly how to get out of there. They're not just like, oh, how do I get out after I kill this guy? Like, as investors, you have to think of the same way. You're investor assassins. This is probably a bad way to go, but if you think about it that way, you're always looking for the exit. It doesn't mean that you don't ride it up 1,000% if that's where it goes. It just means you have to have a plan to get out. And so when we talk about risk management in the show, we're telling you all of the landmines and potholes to look out for. Hey, housing is a disaster. You should be careful. Now, it doesn't mean you should not invest in housing. It means you should be careful. It means you probably shouldn't invest in office space because that's a disaster. But residential multifamily apartments, they're doing okay in certain areas. It doesn't mean all real estate's bad. It means that the numbers are not going to add up in your favor in the same way that they did 3 years ago. So, it's the same thing with any other investment. So um, when we talk about some of the things like we talked about Stan Druckenmiller and his sentiments of why he got out of the 87 before the 87 crash, and those are the same sentiments we have today. That's a caution for you. It doesn't mean you should put all your money under the mattress and hide in your bunker in the basement with your MREs and your guns. No, I'm saying that it is really expensive. Historically speaking, there's some really big markers that you should be very, very cautious of, but it doesn't mean you can't be invested in the market. So the reason I'm talking about this because I thought it was a great message, and um, I really appreciate Stephen sharing because everyone else is thinking similarly. They're thinking, "Oh, he's a perma bear." No, I'm not. The bear market thesis is always the most intellectually interesting. So if you find yourself being a perma bear, it's because you're looking at it intellectually and you're saying, "Well, these numbers don't add up, so this is bearish." True. It is true. However, the markets are perpetually bullish. The markets tend to go up 70% of the time and they tend to go down 30% of the time, which means that overall, if you had to flip a coin 10 times, then you want to be bullish, right? 7 out of 10 times you're going to be bullish. So that's how to think about it, right? Is you don't, there's many frameworks we can talk about, but you have to keep in mind that even though you can be bearish, and I talk to a lot of people, clients, prospective clients, listeners in the show, and they talk about, hey, I'm really scared of this and the GDP and the election. And I was on LinkedIn yesterday and Ray Dalio posted a post about a potential civil war in this country. I got news for him. Ray Dalio is a smart guy, but I got news for him. There's not going to be a civil war in this country. I don't care who you talk to. Everybody's trying to whip you in a frenzy. There's less than 1% of the people in this country that have any interest in that. Everybody else, Doug and I may disagree politically. I don't think we do too much, but we may. I'm not going to go shoot Doug, right? I'm not going to go fight against Doug because I don't agree with his opinions. That's just stupid, right? And the media makes it sound like we've got a bunch of people sitting in their houses waiting to attack their neighbors with guns and whatever the hell they're doing. It's just not true. And so we have this sentiment that's being perpetuated in the media, which is why I don't watch the news, by the way, is it's always negative. Always, always, always negative. Oh, here are the people who died today. Here are the extremists that are going to ruin the country. And there's like 3 people in a hut in the middle of the woods and no other people, just 3 in the whole country. And they're worried about the 3 people taking over the country. It's ridiculous. So there is a curiosity in the bearish nature of things. People tend to be interested in novelty, sex, novelty, and violence. And people are interested in that. It's just this human nature. It's just how we are wired. So if you find yourself being bearish, try to push the envelope and try to look at the bullish side always. Because even now, like we are very bearish on the economy. I don't know when the recession is going to hit. It could be 3 years from now because the economy is very resilient. We're not out of the market. Just because I said before we have a lot of treasuries that are paying 5%, that's great. Those are a great investment right now. Does that mean you should be on treasuries? I don't know. Like everyone's different. If you're retired, it's probably not a bad strategy. You don't have to take too much risk, but you also might miss out on the bull market going on in everything. Everything's going up right. Well, virtually everything's going up right now. That should be a sign that if you're bearish, right, and the market is taking off and it's going through the roof, you have to look at that and say, "Huh, isn't that interesting? Where am I wrong?" You always have to ask yourself that question. Where am I wrong? So if I'm looking at the market and I'm bearish, I'm shorting the market and the market just keeps going higher, you have to ask yourself, "Huh, isn't that interesting? Where am I wrong? Where is my thesis incorrect that the market is getting this right and I'm getting it wrong?" Now, if you're sitting in the sidelines in bonds, you're not really wrong. You're just missing out on the bull market. If you're short the market, I'd be very, very careful in this market because it's crazy. But if you think about that perspective, you always have to be able to take both sides of the argument. What is the bearish case? What's the bullish case? And it could be like gold this past week just went up from like 190 to broke 200 and went to all-time highs. And that's in the GLD. That's up 5% in a few days. That's crazy for gold. Bitcoin, Ethereum, all those have gone through the roof. The S&P's done well. Like a lot of markets, international markets, everything's doing well. So if you're bearish, it doesn't mean you're wrong. It just means you have to think about, where am I wrong, and am I willing to accept this pain? Because at some point you have to you can't ride it all the way up in shorting, because you'll lose all your money. So you have to be careful about investing, and you have to understand both sides. And at some point you have to say, you know what? I thought it was going to go down from here. It didn't. Everyone I talked to thought February would be the month it would go down. It didn't. Kept going higher. It's March, still going higher. At what point are we wrong? Ask yourself that question. If you're going against the grain in the market, try to figure out where you're wrong. What are your thoughts, Doug?
Like always, I have a few. First of all, I'm really glad to know that you're not going to attack me in a Civil War fashion or whip me, beat me. Thank you very much for that. I think a couple of things that gets confused a lot, and especially now, and let's take a step back and think for a moment about what we have witnessed here in a historic fashion economically. We have seen the greatest run of positive market momentum in history, okay, without a real major pullback. And if you are in this industry enough, either as a professional or a customer, you're going to hear people talk about the pendulum swing, right? So generally, and something also called reversion to the mean, which means eventually things have to come back to the middle, or they tend to, at least. Again, anything's possible. It doesn't have to. What does that mean? It means that if you were to swing a pendulum one way, gravity's going to pull it the other way. Generally speaking, what happens is if you swing a pendulum further, it's going to come back harder and faster to that opposite direction. Some of this could be exemplified in what happened after the dot-coms. I mean, the 90s were, before this, the greatest run of prosperity in the markets. And then, prior to that, basically the 20s, which were built upon fraud and misinformation. There's a lot of reasons that led to the Great Depression. So you take a look at that pendulum swing and you say, okay, what happened with the dot-coms? You had billions of dollars created out of fluff, right? Companies that had 4 employees that never built anything were selling for billions. You evaporate that kind of wealth into nothing, it's going to have a reversionary impact. And what happened? Well, we basically spent the next 13 years after 2000 of a negative markets, and people forget that. After we really gave back the credit crisis, changed some things, regulation, QE, and all that, since 2008-9 area, for the most part, with a couple of situations, the markets have been on a massive run. So why do we sound bearish? I think the issue is, given the circumstances, it is, as Kirk's talking about being able to understand risk, it is going to be bearish if you are bringing to light the reality of things that you to be aware of that are potential risks inside of a fully bullish type scenario. Okay. It is really pragmatic thinking to look at, okay, when things are going well, what are some things that could go wrong? And there is a lot of data out there of things that historically have led to, as leading indicators to, not that risk is ever gone, but leading to the trigger, the spark that causes that risk to finally create the explosion. Okay. If you look at someone who most people consider to be a perma bull, Warren Buffett. Okay. Warren Buffett is always pragmatic about the future of stock markets. And he's told the average retail investor, just buy the S&P 500 and let it go. You can't outthink this. But yet Warren Buffett is telling you that he's doing some things differently in protecting risk when he continues to raise billions of dollars of cash and not deploy it. Okay. That is a contrarian thinking to what is going on, to be prepared for the things that might come. Now, let's say the market did completely implode. Let's say it gets completely bearish. Well, there's a good chance that what you're going to hear Kirk and I talk about here is going to be the contrarian arguments as to why it's time to start being bullish, because it is our job to look at both aspects of what's going on and to dispel this blind corridor of information that typically is received by people through the media. Okay. And as he said, don't follow the news. So right now, when all the news is good, it is important to begin to also recognize where there might be cracks. The other thing Kirk talked about is, people calling in, I got this 15, 20% return. This always brings to mind to me, the misunderstanding of how returns are calculated. So a lot of people say, hey, I got 20% in my 401k. Tell me more about how you got that 20%. What people don't recognize is that a lot of the calculators of returns in these do not quantify what we call the time weighted return, which is actually taking into what the investments you did were able to grow after you extract out new money added or money taken out. So a lot of times returns people see in their 401ks, well, I got 20%. How much of that was the actual investments? It might have been 10, like Kirk was saying. 20%, 10% of that was actually the money you put in from your savings. And then all they're looking at is where you are today, where you were before. Congratulations, 20% return. It does not mean that your portfolio made 20%. The other thing you talked about, sex, novelty, and violence, go back to Hollywood. What doesn't sell in Hollywood? Generally artsy, boring films that are going to be really benign about life. Okay, wonderful. They win Oscars. They don't typically, create the records on the number of tickets that are sold to the theaters. Oftentimes they don't stay in the theaters very long. It is extremely rare for those type of movies to actually get any type of momentum. What makes the millions and millions of dollars? Movies with sex, movies with drugs, movies without violence. Okay. The horror film culture genre is still a massive moneymaker for Hollywood. Let's face it, there is a whole separate category trying to keep this PC of things out there that still you can go on and sign on the internet if you want. They make billions of dollars more than Hollywood ever does, focused on one thing. That's what sells. That's what they'll continue to push. The last thing I wanted to say, you brought up Druckenmiller, and I think it's an perfect segue to this. Kirk, I just posted something in our channel. It's one of the last things that I posted. Yes, we've talked about how Druckenmiller saw an opportunity to be able to get out of the markets, before he saw them crash in 2008. And he talks about it. And he's considered someone that's pretty bearish. He's someone that came into the last couple of years talking about a hard landing. Okay. This is what he's been holding, right? Look at the investments in NVIDIA. Look at the investments in Microsoft. Look at the investments in information technology and finance and consumer staples. And most importantly, look at the green on the right. Okay. So again, from a pragmatic standpoint of looking at where there may be risks, and he is certainly vocal about where those risks can manifest. And he's certainly vocal about the importance of viewing those risks with prudence and being prepared. Has it meant that Stan Druckenmiller has not been investing? And has it meant that Stan Druckenmiller has only been investing in things that would do well if the world went and crashed? Absolutely not. So it's a perfect example that even when you start to get the news of potentially negative, this is his 13F. He's preached recession. He's preached hard landing, and yet he made a killing in NVIDIA and let's see, LLY, which is healthcare.
Eli Lilly.
Yeah, Eli Lilly. Thank you. So he's made a killing in those things. So again, just because we are being pragmatic and maybe contrarian about some of the things you need to be aware of that you're not being told, does not mean don't go out there and invest. But it does mean, and neither is most of the time the people that are telling you to be pragmatic. Watch what they do, not necessarily what they say, but at the same time, it also means that even though you may still be actively invested, be active, be cautious, and recognize what could occur given the number of things that are out there that might go contrary to the news of the current state.
Yeah, no, thanks, Doug. There's a few things I want to touch on here, which I found interesting, and you were nice enough to share them. One of them is this. So this gets into what we were talking about before of bullish versus bearish. I don't know if you home gamers remember this, but certainly back in December, you probably, if you were listening to this podcast, you probably did remember this, as we were talking about the expectations of the market versus reality. And they were so far on one side. We had bank analysts coming out and saying, well, we're going to have 7 rate cuts next year. And everyone was like, we're not going to, it's going to go back to zero. And the market was doing just fine. I mean, the market was skyrocketing. And yet people were talking about so many rate cuts, and it was just crazy. I mean, it was absolutely nuts. And then beginning of the year, obviously January, the first week of the year, the market went down and it kind of bounced around for a while, and then obviously it's gone through the roof. But the point was is that the market had crazy expectations, and we talked about in the show they were crazy. They were totally off base, and I still predict that we probably won't have any rate drops, maybe one. That's been my prediction for a while, and I think it still holds true. We're 3 months in, and Powell came out and he gave a wishy-washy answer, but basically he's pushing it out. If the market keeps going higher, they are not dropping rates. And I've said this very clearly in the show, and I want to be really crystal clear, because when I go back and I kind of stand on the soapbox and parade around our wins, the reality is we have losses too, right? We make stupid calls sometimes. We make good calls, but this one I'm pretty good at predicting the economic effects. That's something I actually am pretty good at. That doesn't always translate to the market, right? Because you could have a bad economy and a good market, and a good and a good market and a bad economy. I mean, they can flip flop, but effectively, one thing is clear to me, and there are some questions, right? I've got some questions, and we don't have an answer because we haven't been in this situation yet. But if you have a market that's at all-time highs and you have inflation that's not skyrocketing, they're not dropping rates. They might even raise rates. Now, I'm not claiming they're going to raise rates, although if the market keeps going higher, I might have to make that claim because it's getting a little nutty. But generally speaking, like, they're not dropping rates when the market's going haywire. Now, here's an example. Here's a screen. It says more economists now see a soft landing. Now, I don't know if you remember a year ago, 2 years ago, everyone thought soft landing was ridiculous, myself included. I still don't think we're having a soft landing. Doing a soft landing is like trying to land a plane on the Hudson on top of a rowboat. It's just so next to impossible to do that it's for Powell to do it. I mean, if he does it, kudos to him, but I think the probability is really low. But it doesn't mean it can't happen. And so before, as you see on the left side, January, like a year ago, 61% said a recession in the next 12 months. 39% said no on a recession. Now it's 61% on no on a recession in the next 12 months, 39% on a yes, which probably means we're right around the corner. We're going to have a recession, because the majority tends to be wrong. But what it shows that there's so many people who are throwing in the towel, like, well, we haven't seen a recession. I don't know what's going on, but I'm just going to go all in, and that's just the way it's going to be. So I think what we're seeing is a turning of the tide. People are starting to get more bullish, which is a good thing, but it doesn't mean that it's going to continue, because ultimately fundamentals do drive the market to some extent, even though sentiment drives most of it. Sentiment's the short term, fundamentals the long term. So sentiment is showing, hey, we're bullish, and the markets are showing that. Everything's up, international, domestic. The dollar's down, but like gold's up, crypto. Like, I look at my screen, everything's green. There's no reason it should be that way, but it is. And so at some point, the reality has to hit people square in the face. But for now, it doesn't mean you don't take, like Stan Druckenmiller. He's not sitting on the sidelines saying the market's wrong and I'm right, because that's a exercise in futility. Well, the market's wrong. Okay, so what? The price is the price. It doesn't matter if it's wrong. The price is the final arbiter. And even if it's wrong, it's still the price. So you can argue till you're blue in the face and lose money, or you can jump on the bandwagon and make money. So just sometimes you have to fight against your own internal bearishness. And like I said, I'm not saying you should jump in and go all in the markets. I'm just saying you have to fight against your natural instincts to to be fearful or greedy. And when the market's in a perpetual bull market, when we get into these crazy times, like, I'll be honest with you, Doug, I've been here a few times because I've been doing this for 25 years. This feels a lot like a blow off top. And I'm not sure where that ends. We could be 30% higher from here before that happens. But to me, it's feeling very toppy. It's feeling like a runaway bull market, which doesn't end well. It doesn't mean you can't make money along the way, but it doesn't end well. And so you should just be cautious about this. But, it's kind of like you put one foot in, you put one foot out, you dance all around and I forget how the song goes, but
Hokey
basically
pokey.
the hokey pokey. Yeah, I haven't done the hokey pokey in a while. But that's the kind of thing you have to do. You have to be agile and flexible in your thinking. And some of the best traders in the world, I know George Soros for all his faults, and I know a lot of people don't like him, myself included. But I have to give him credit where credit's due. He's one of the foremost, the best traders of our time. And when he used to talk about it, he's like, "Well, I go all in. If I'm wrong, I'll just reverse the trade." He's like, "Yeah, I put 100,000 shares into ABC stock, and it goes against me. Then I short 200,000. I go the other way." Like he's agile. He's not set in his ways in the sense that he knows it's going one way. He's like, well, the market proved me wrong. I'm going to go the other way and start making money. I mean, the best traders in the world do that. It's really hard to do, though, because we come up with our thesis and then we're like, you like concentrate so hard you think the market's going to move in your direction and it's not. It's like this just happens. You just have to be aware that it's like big tech right now. Big tech has led us up for the last 15 years, and now it's maybe not as good. Not all of them. Some of them are good, some aren't. And people are like, well, it's going to keep going higher. Maybe, but what if it doesn't? Then what? Are you gonna will it higher? You can't will it to do anything. You just have to be aware that the market's going to do what it's going to do, and you have no control over it. It kind of makes me think of this chart. Thank you, Doug. This is brilliant. This is a chart. It was on a Twitter feed, and for those of you home gamers, you have to see this. I'm going to put it in the show notes. Is absolutely hilarious, and it's a chart. It looks like a technical trader went nuts and went crazy. It's just there's like 50 million lines on the chart. You can't even see what the chart is, but there's lines everywhere, and it's like, and somebody can look at this and be like, yeah, here's my thesis.
The tweet itself was Bitcoin just hit 60,000. If this means it's going to 1 million next, see the chart below.
I mean, it's so brilliant because there's so many people who live like this. They're like, they've got like 20 different indicators in the chart. And they're like, well, if it does this, this, and this, then this is going to happen.
It's all of our chart crimes explained in one chart.
It is. It's exactly it. This is a chart crime in itself. But if you don't get that as a chart crime, like you don't have a sense of humor because it's so hilarious. But somebody look at this like, wait, I don't understand. I'm like, exactly. Like this made my day. Thank you, Doug, for making my day with this chart. This is absolutely brilliant. But I think there was another chart crime in here that I wanted to share too.
Found a couple recently. We can have some fun with.
Here's two more. This isn't a chart crime, but I think it's worthwhile. So here's a chart of the S&P 500 index, and it's marked with blue dots of a government shutdown. Now, I want to point this out for one major reason. And the major reason is this. First off, we've had, it looks like 6 government shutdowns in the last 35 years, somewhere thereabouts.
And everything blew up.
Right. Wait. And yeah. And the market, it kept going higher. Wait a minute. Government shutdowns aren't the end of the world. So remember back, like, I don't know, in the last 10 whatever years, maybe it's longer than that, 15 years, I think during the Obama administration, the government shut down, so the world's going to end, and people didn't get paid for a week. And, obviously we don't encourage that, but yeah, the world didn't end. The point is we get this fear mongering from the media. The end of the world is going to happen if the government shuts down. And somebody wrote a tweet after the last one. They're like, can we make this permanent? Because at the time they were talking about making like the tax code permanent, the government shutdown. Can we make this permanent? Because that would actually be great. Anyway, so what you see here on the chart is obviously there's like one dip in the government shutdown, but the world doesn't end. Actually, the bigger dips were not from a government shutdown; they're from other things. So it was kind of like it's more of fake news, as people would say, that a government shutdown leads to bad things. It doesn't, right? It obviously doesn't, because the government shutdowns, actually the markets just keep going higher. It didn't stop a thing. So I wanted to point that out, because I don't know, every few months we get the fear of a government shutdown, the world's going to end, and obviously the world doesn't end. Here's a funny one. Let me let me give this funny one, and I'm going to talk about one more thing, and I'll give it back to Doug. So here's a chart of, I think it's Bitcoin. So here's a Bitcoin chart from 2011, and then it's an overlay on the Dune movie. So I had to share this because it looks like the peak of Bitcoin in 2017 was when the Dune movie was announced. And the peak in 2021 was when the Dune movie came out. And then it shows Dune movie 2 came out in March 1st. Obviously it's not the peak. I was like, it's hilarious. Like, the fact that people do these things and like, hey, look at the correlation, it means Bitcoin's going to crash. If you're ever tempted to sell your Bitcoin position because the next Dune movie came out, I'm sorry, I feel for you. Please listen to this show more, and hopefully we can help you. But I thought this is hilarious. I love seeing charts like this because it just makes me laugh of how silly people get. And I know this was meant to be comedy, but I love it. Like, everyone takes things so seriously. If you can't have fun with some of the craziness out there, then you really need to go to a comedy show and get a sense of humor, because the world is a crazy place and you need to be able to laugh at it once in a while. So I just wanted to share that before I get into the State of Union, which wasn't as comical as I was hoping. I guess I was hoping to see some bumbles from Weekend at Bernie's, but I guess they had a good stash of Adderall in the White House, and he managed to get through it. So kudos to Bernie for doing that. But I did want to point out some of the things that were on the list, because obviously he wants to get elected again. So he said a few things to get him elected. Who knows if they'll happen? This happens to every president, so I'm not picking on him. Every president does this. But basically, he's saying he wants to raise the minimum tax for multinational corporations 21%. All right, well, good luck with that, because your campaign financing is going to dry up overnight. So I don't expect that to happen. It's more of a campaign promise that never happens. He wants to lift the corporate tax to 28% from 21%. All right, good luck with that too. If you really want to kill our economy, that's a great way to do that, and that's why the Trump economy did well. It's not because necessarily anything other than the fact that he was able to lower taxes on corporations, and they're able to put that money to work. Now, he did say, I will say, here's something interesting. He did say he wanted to raise the tax on corporate stock buybacks from 1% to 4%. Now, what is interesting is the reason for why he wanted to do that. And the reason was to encourage companies to spend more of their revenue on salaries and improving productivity. That, in my opinion, and I know some people agree, is backwards thinking. And here's why. I'm not saying it's bad. I mean, hell yeah, pay employees more money. Who doesn't want that? But the reality is that these companies are not going to be incentivized to pay their employees. They're going to be incentivized to do something else. They might be incentivized to expand, but the smart ones are not expanding because they know that the economy is such that, well, we got to borrow money, we got to do this. It's not incentivized to do that. Here's the reason why they buy back their stock in the first place. And if you're proposing something like this, you obviously don't understand human nature. Because if you create, and I thought this was a good framework, somebody said this a while ago, is that if you're creating policy that goes against human nature, it's bound to fail or lead to disaster, because it doesn't mean it's not going to change things, but inevitably it leads to disaster, either because it's against human nature and it's just bad for people, or people take advantage of it, right? They might say, well, there are examples of it working. Yeah, of course there are examples. But generally speaking, policy that goes against human nature eventually fails or causes disaster. And that's just the way it goes. So if you want to create policy, it has to go with human nature. That's the most successful policy because it aligns with how human beings operate, not against it, right? If you're trying to purport that communism is a way to go, that's against human nature, right? I mean, look at communist Russia, which most people don't remember, but back then You weren't incentivized to work. You got paid whether you worked or not. So why should I show up to work and do any work? So then what happens? Then you create crappy products and you create the Yugo and you create these watches that fall apart when they get hit with a drop of water. I mean, I played a bunch of Russian hockey players when I was younger. Great kids, great families, great people, but they used to trade their stuff for our stuff. My dad's like, don't trade for their stuff. Their stuff's junk. We just did it because it was like hard to get and it was kind of cool. But I remember getting a watch. I traded a watch with a kid. Like I had a Mickey Mouse watch and traded him for a Russian watch. It was really cool. And then the thing fell apart after 3 months and just started to fall apart. But when you have policies that are against human nature, you're incentivizing the wrong behavior. So here's the thing: if you're raising a corporate tax on stock buybacks from 1% to 4%, all you're doing is having them reassess and say, well, it's still better for our shareholders. Remember, they work for their shareholders, even though some of them work for themselves, but they work for the shareholders. So if it's still incentivized from 1% to 4% for them to buy back shares, they're going to continue doing it. Because if they see I can invest in this project and make 1%, or I can invest in a buyback and make 20%, well, hell yeah, I'm going to invest in that buyback. Why not? Right? It makes sense. So you can't incentivize companies to not buy back their shares. It's nonsensical. They're going to do what they're doing. Now, if you want to incentivize them not to buy back shares, make the economic environment better so it's more supportive of them spending on manufacturing, building new plants, hiring more people, expanding. That's how you get them to pay money to that, not this other stuff. This other stuff is there because we had 0% interest rates for 20 years. Of course they're going to do that. Why? I mean, it actually took corporations over 10 years to figure it out. They really started to go all in. I think it was back in 13, 14, somewhere in there. They started to really go all in and buy back their shares, and they're pumping up stock prices. But that's not their fault. It's like going after Wall Street and saying, "You greedy Wall Street people, like you're taking our money." Their job is that. Their job is to take your money and make money with it and hand back more money, and they get a piece of it. That's their entire job. And you're saying, well, you shouldn't make as much money. Okay. So what are you going to do about it? I mean, you can't tell people they can't make money when their entire job is to make money. Their job isn't to make widgets. It's to take dollars and create more dollars with them. So you're going to yell at them for doing that? That's their entire job. So when you have companies where they're incentivized to make money for their shareholders, right? We're not all Disney. Where most companies are there to make money for their shareholders. And so when they do that, they're looking at what's the most money I can make from this money. And now, as a business owner myself, and Doug's a business owner, my job is to say, hey, all right, I got this extra $100. What can I do with it? Well, I could go hire a new employee, which costs me probably an extra, whatever, 30 grand a year, let's say, right? Let me make the numbers reasonable. I can take this $100 and spend it on an employee, which really leads to more $100 stacked up over time. Or I could take that $100 and invest it into a marketing campaign that leads to $500. Well, crap, I'm going to do that, right? That's a better use of my money. I'm taking $1 and turning it to $5 instead of taking $1 and turning it to $0. Now you need some employees to support that growth, but the point is companies are not there to supply jobs for people. That's not their point. And I know there are people out there like, oh, you got to get jobs. No, that's not their goal. Their goal is not to give you a job, right? Your goal is to show them that you can make them more money so you earn that job. Like, I remember reading something in the Great Depression where nobody had jobs, and the people who actually got work were the ones walking into a shop and saying, hey, man, I see you don't want workers. Let me do this. I'm going to work for you for free, and I'm going to make you $100, and you're going to give me $20 of that. Great. I don't have to pay you. You're going to go sell for me. Go ahead. Right. I'll hire people all day if they want that kind of job, right? Because it doesn't cost me anything. But if I have to pay you and you're a cost center, that's a challenge. So companies obviously pull back on that when times are tough. Now, I would also argue that corporations are really pinching pennies, and there's other things going on there. But I think when you propose something like that, you're really going against human nature, and you're not really solving a problem. Stop letting corporations get tax deductions for all employee salaries over $1 million. Okay, I mean, I get that. I mean, I'm not going to go against that. I get what you're trying to incentivize, but it's still not going to move the needle. So instead of making 25 million, maybe they only make 20. I mean, it doesn't really stop the problem. The problem is cheap money. If you didn't have interest rates at 0% for 20 years, then we wouldn't have this problem. If you have interest rates at 10%, I guarantee you they're not doing all this shenanigans that they were doing the last 20 years, because they won't be able to. And so when you have 0% interest rates, that causes problems, and then you blame other people. You can't do that. Our government does it continuously. The problem has been low interest rates, and that has led to all these other challenges. Making billionaires pay a minimum 25% income tax. Well, that's interesting. But how are you going to do that? I mean, so if you think about billionaires, do you think they're making $1 billion a year in income? No, they're not. They have $1 billion in stock, and that stock is going up, up, up. Look at Warren Buffett. Warren Buffett talks about this. I don't know what he's making now, but there was a time where he was making very little, and he's a billionaire because he has this stock that he's never going to sell. So how are you going to tax that? You can't tax the asset, because then everybody sells it and then the economy goes in the toilet. So if you're proposing that, it's a dumb idea. But if you're proposing to tax, and how are you going to dictate what somebody's net worth is? I think it's bad math, and it's not a good idea. But if you want to tax people higher that have a high income, okay. I mean, then raise the income taxes on those people, right? See, the issue is you have a lot of, it gets complicated. I'm not going to get into it here, but it gets complicated from the tax, and they have AMT and all these other things. I mean, look at, I think there was a story out back when John Kerry was running for president that his wife, or whatever woman he's married to, Teresa Hines, who's definitely smarter than him, in my opinion, she had a lot of muni bonds, and she was basically making a lot of money tax-free. And people say, well, you should pay taxes on that. Okay, so let's play this out. I can make $1 million a year income tax-free from muni bonds. You'd say, well, you shouldn't do that. Okay. So let's say you start taxing me on muni bonds. Well, now I no longer buy muni bonds because there's no incentive for me to buy muni bonds. Now, if you understand muni bonds, that's the municipality or state borrowing money from the public at a low interest rate, let's say 3%. So the state pays you 3% to borrow $1 billion. And you're going to buy that bond and get 3% because it's tax-free, which is the equivalent of maybe, let's say, 5%. I know the numbers are off. 5% taxable. Okay, well, that's better than the market's getting, so I'll invest in that and I don't have to pay taxes. So there's a reason people buy that. So if you start de-incentivizing people to buy those, now they can't sell them at 3%. Now they can sell them at 5 or 6, which means the municipality pays more money. And that comes out of everyone's pocket. So by going after the millionaires, you're actually going after everyone, including the common people. So the unintended consequences of some of these things are just bad news for the economy. Now, there are some policies, and I'm not knocking all the policies that he laid out, as you can tell, but I think they need to be well thought out, and they can't just be, well, we're going after millionaires and billionaires because the common folk want blood. Well, I get it. I mean, that's soapbox stuff, but it's not good policy. You can't go after the millionaires and billionaires, or they leave. If you go after big business and you say, well, Bitcoin and crypto is a bad business, then they go overseas and we lose all that revenue. We did that years ago with credit default swaps. We made it too difficult, so people went over to the UK, and they're like the center hub over there. All right, so we just lost millions and billions of dollars of tax revenue. Good job. I mean, that's what happens, right? You have to think about what the outcome is, and I think most times people do it to get elected, but they don't do it to actually have efficacy on their policies. So, Doug, you want to talk about some stuff, and we can bring it home?
Yeah,
one more thing. Sorry, $5,000 credit for first-time home buyers for their first 2 years of their mortgage. I have to say, I like the direction, but that's like tone deaf. $5,000. You know how much a first-time home costs nowadays? You want to give me $100,000 credit? Now you're talking. You're talking about a $5,000. What does he think this is? 1970? That's not going to go anywhere. Anyway, off to you, Doug.
Yeah, you know what? And there's certainly the thing that people don't think about when you start getting that much of a discount on credits and stuff like that. When you give people more income, it automatically leads to more inflation. Okay, unless they have a place to put it. We've talked about that. And again, QE did not lead to inflation after 2008 because those got reabsorbed in goods and services. We saw what happened in 2020 when people are just given money. and ultimately the goods and services are constant. We're trying to fight inflation. People can't afford it. They're not going to be afford it anymore if you give them more money. The other thing I look at when I see the raise the tax on corporate stock buybacks from 1% to 4%. On one side of the aisle, you've got the Reaganomics, people who believe that what Reagan's level of economics was a great thing. And on the other side, you get the people that talk about the failure of trickle-down economics. This is trickle-down economics just repackaged. Right? If you think about what's the point of what was the intent of trickle-down economics? If you cut taxes, they'll have more revenue and they'll have more profit, which will then invest in their infrastructure, trickling down to create more jobs. Okay. Well, what are they saying here? If you create a barrier for them using their money to do stock buybacks, they will then have more money internally that they will then trickle down to hire more jobs and create more and invest in more infrastructure. People, it's the exact same concept, two different ways. One is give them more profit by lowering their their government expense. The other is force a government expense to force them to redirect their proceeds. It's the same thing. So this is where you get one side arguing the other side, semantics. But I have to break it to you. This is trickle down economics right here. And if you don't believe Reaganomics worked, this won't either. End of story. And ultimately, which one has a greater effect? Well, that's hard to say because if you reduce taxes, and then there are people that believe that taxes get reinvested in infrastructure and jobs and GDP, et cetera. Okay, whether you're right or wrong, not here to argue that. But if you restrict buybacks, let's say there is an effect. Let's say that 4% tax forces them to no longer do those stock buybacks. What's the impact of that? Well, many employees of these companies that you're trying to, increase the hiring on have company stock in one way or another through stock purchase plans in their 401ks. You have outside investors and individuals that own these stocks that, of course, are going to be impacted by this news. And if analysts and investors decide that it's no longer a good stock to invest in, they're going to put their money elsewhere. That's going to lower stock prices. Nobody thinks of it. Let's talk about trickle down. Nobody thinks about the trickling down effect of these decisions other than what sounds good in a soundbite and meandering and pandering to a constituency. The reality of it is you create more restrictions in one way or another, it's going to have an impact. And that impact has more than just one net result. Okay. Because guess what? Kirk, I'd like what you said, these companies are not in the business of hiring people. Yes and no. Public entities have effectively become publicly run job farms. Okay. So are they in the business of hiring people? No, they're not in the business of going out and hiring more people. But this multi-billion-dollar corporation, every single person in this business is an employee. As a matter of fact, the CEOs in most cases were not the founders. They had nothing to do with the creation. They are nothing but a high-paid employee. So what are public companies? They are basically public, private, but publicly owned governments. That's what they've become. They're there to basically create jobs. Do they create anything? Yes, sometimes they still can. But in many cases, the impact of the health of that business does have sometimes a direct, in many cases, an indirect benefit or impact on the overall economy because of the trickle down of revenue to salaries and how those salaries get reinvested in our economy. But that's what they are. They are basically job farms. And if you don't like corporations, I've said this before, and you don't like the taxes of corporations, or I'm sorry, the revenues and profits of corporations, then the greatest thing that you can do to combat that is go buy the stock. Because if you buy the stock, now you're a direct recipient of those tax breaks. Corporations are not individuals. They don't feel tax pain. It's all of the individuals that make up the collective of it that do. I'll turn it back to you because you're on a great roll, and I don't even want to. I don't know what direction you want me to go. It's 1:00 here, Kirk, so I'm going to let you take it in, unless you just want me to kind of give a little bit of a who am I and where to find me here.
Yeah, I'm gonna hit one more topic and let you wrap it up, Doug. And this topic, I'm gonna stand on my soapbox and with my peacock hat on. I don't have one with me, but basically, we talked about this in the show for years. Nuclear energy is the best way to solve climate change if you believe it. That is by far, in a way, I'm not debating whether it's true, climate change is true or not. Some people believe it, some don't. But the reality is, no matter what you believe, nuclear energy is the best energy out there. It's the cheapest, it's the cleanest. Nobody can object to it. And yet, no one has done a darn thing in years. In in the 70s, it's been 50 years, and no one's done a darn thing until today. Or not today, technically, it was a week ago. But I believe that the House passed a bipartisan legislation advancing nuclear energy production. Now, this is awesome. And I believe it passed like 10 to 1. It was like 300 to 10, 300 to 30, 300 for 30 against, somewhere like that. So overwhelmingly bipartisanship support of this, which I'm going to take some credit. I think, a little bit. I think Michael Schellenberger probably did more to push this forward than I did, but I got to take at least a little bit of credit, and I think everyone else who've had on the show and have talked about this gets credit, because this is something that it's a nonsensical reason why this shouldn't happen. We're not building nuclear plants in this country. China and India are building them. We're still burning coal and putting up solar panels, and we won't build a nuclear plant, which solves a lot of our problems from an energy perspective. And so if you think that all these other energies, if you think wind power and solar are great load power, and those of you who don't know load power, it means it's consistent. It means it's always on. So at night, obviously, solar doesn't work. And when wind stops blowing, it doesn't work. So that's not load power. And so you can't run a grid on solar and wind. You can run a grid on nuclear and coal, which everybody agrees coal's not great to burn, but we do it because it's cheap. And and there are other things that are we don't have enough of, like hydropower, but it's not enough. And geothermal, which actually is my favorite, it's clean, it's great, but we just don't have the we're not the
we don't have enough volcanoes near the surface, near major cities.
Right. The crust is not thin enough to do that. Like Japan's a great place. You can look in the West Coast, you can get some. But generally speaking, we're not the best place to do geothermal. But nuclear, you can. And so I'm glad to hear that the politicians have got their head out of their collective butt and they're actually trying to push this forward. Now, whether it passes, who knows? But if we could do that, and actually, all it did was and actually, to be frank, the reason that this is a problem is because of all of the governmental red tape around this is what makes it so hard to happen. So if you build a plant, it might take you 20 years. It's not that it takes 20 years, it's the government red tape takes 20 years to get through. It's like India. I mean, India, one of their biggest problems is red tape. And so, when they starting a business, red tape is a huge issue there. So same here. Like, you need to make it simple and easy to build these plants. You need to get rid of all of the government, fingers in the pie, and just let these people put them up. There's great technology out there. There's great contractors out there and engineers and all this that can do this. You just need to let them do it, because if you don't, we're going to have a lot of energy issues in this country. And let's be frank, no one wants a war in the Middle East, but I can guarantee you, if everyone's got nuclear power, no one's going to give a crap about oil in the Middle East. And all of a sudden it'll become let me frame this right so people don't take this and make me sound like a jerk, but we're going to treat the Middle East like we treat Africa, right? Like we don't go to war in Africa every week because of some resource. I mean, I'm sure it's there, and I don't want to minimize this because there are wars and there's bad stuff happening there. But like, we don't look at Africa like, oh, well, we need to control Africa. We're like, we need to control certain areas that have resources, but as a continent, we don't get in it. In Middle East, we probably wouldn't get in either if there wasn't oil. I mean, I'm just being honest. Like, if there wasn't oil there, we wouldn't care about them. And that's politically kind of how the world looks at it. Not me, but as a country, we don't have the same incentives because everyone's fighting for energy. Everyone in the world is fighting for energy. And the more cheap energy we have, the more technologically advanced and the more progress we can make as a species. So if we had free energy, the amount of stuff we could do would be amazing. But we don't. We have to pay for it. And because of that, it slows down progress. Imagine the progress we could make as a species if we had free or really, really, really cheap clean energy. It'd be amazing. And nuclear may not be perfect, but it's the best we got. And that's the reality, right? Is I'm not, you can disagree with me, but the reality is the numbers are the numbers, and you can fight me on the numbers, but they're true. Nuclear is the best. You could say, well, it might melt down, maybe, but also there's more injuries from other sources than there is from nuclear historically. So I don't think anybody's died from nuclear plants, even some of the damaged ones. I don't believe. I don't know about Chernobyl, but any others, there's been no deaths. So, and there's been deaths in everything, windmills, all these things. There's the coal, but anyway, I'm not going to get in a soapbox on this. I just wanted to point out that this is actually making progress, and golf clap for all those who made it happen. And hopefully there are more to come, and hopefully there's a lot more progress, because I think if everybody can get on board in this, it solves everybody's problems. It solves problems on the left, solves problems on the right. Maybe the big energy companies might not agree, but hey, if they're smart, they'll get into nuclear, and they'll make money there too. So I think everybody wins if we go down this path. So let's all cross our fingers, and hopefully the politicians don't trip over themselves on the way to the voting booth to vote in favor of this. So, Doug, wrap it up here so we can take it home.
Well, one last thing I want to say on this is, again, if you talked to earlier about all the things that are going up, including gold right now, and again, not saying a gold bull, just be aware that as we talk about those contrarian indicators, gold is one of those things that also can be a leading indicator of some things. So the fact that it's moving, the dollar's falling, again, just things to be aware of that could be potentially be a precursor to some other things. So to wrap things up here, the last 4 weeks, we've actually done some webinars on college planning. A lot of parents have very similar questions. It's a lot of work. It's a lot of money. It's a lot of stress. And ultimately, most people just don't know where to turn to get information. There's tons of information out there, but a lot of Gen Z and Gen Y right now, they are actually going back and hiring travel agents, because as much as you can easily plan a vacation, it's so overwhelming that they end up finding, they did studies, they're going back to the same places because it's too much work. Same thing with college. There's information everywhere, plenty to do it yourself. But at least what they're finding is a lot of people are finding peace of mind by getting some help, or at least having that information disseminated so it's easier. So go to procollegeplanners.com right now, procollegeplanners.com. Also, look up Pro College Planners on Facebook. We've actually posted our last 3 live webinars out there, and we're going to be having some new ones coming up soon. So if you want to learn some more information, you can get the links to the upcoming. The link will be the same as we've used in the past, which is posted there. So Pro College Planners on Facebook, procollegeplanners.com, and actually go download our checklist and our free college money report right now, 5 minutes. It's not going to cost you a thing, so why wouldn't you?
Great. Well, Doug, I really appreciate you coming on the show as always. Thanks for sharing your wisdom with us. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archived shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send him an email, express your feelings. If you're seeking financial advice, talk to an oracle, or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything. But I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.